Pete, let's start with the fact that we're seeing a rally in the markets today on hopes that Congress will pass something. And also there is some talk of reopening the economy following the 15-day period. What are your thoughts on that?
Well, the market has been basically looking for a catalyst to stop selling. One of the problems that we've had throughout this was there didn't seem to be any coordination in policy. You had local officials acting with autonomy that they probably really didn't have. And the market was, it was in a chaotic state. Now, it was in a situation where it was unstable because of its overvaluation. So the coronavirus has simply provided that catalyst. Unfortunately, without some measure of control, that catalyst turned into a wildfire. Now that we're beginning to see a policy coordination, we're beginning to see houses of government work together. We're going to get something that's perhaps a bit more rational and something that's a bit more defined. Investors are taking basically heart to that there is in fact going to be an adult in the room, and that we're going to see a real policy answer to this, and that will limit further downside to equity prices.
Pete, let's talk about some of the aspects of the package, help for student loans, for business payroll tax, loan grants for small businesses, and then mid-size and larger businesses, a credit facility. How are all of those together really going to help the investor ultimately?
Really, I think it's definitely more psychology than it is true economics. There's simply just not enough money in the federal budget to have any one of those programs make enough of a difference to actually move the needle. But it is a coherent response. There'll be some who will be minor winners, modest winners in this. There'll others who will get probably a feel good from it and initially some spendable dollars in pocket. And the belief is that that will be enough to change the psychology of the financial markets to such an extent that we'll have a more positive outlook, and that people will focus on what lies ahead as opposed to what could potentially go wrong.
At this point, people who are about to retire, have worked 30, 35 years, and have seen their 401k plummet, what is your message to them at this point?
Well, one, don't overreact. Don't sell at this level. These things in the past, we've seen them time and time again, where within 12 months' time, you may not be all the way back to where you were, but you've had a pretty decent rebound. And so I think at that juncture, you want to go back and say, all right, is this how I should be invested? Because these events happen with frightening regularity. It's just the nature of the human animal. And to that extent, I would say, hold off here, don't make major changes. And then as we get down the road and the portfolios rebound, if true change is warranted, then basically figure out what that is and implement it. But my caution to investors is that they'll take a lifetime worth of planning, execution, and they'll throw it out the window because we had a 6-week bad period in the marketplace.
Pete, as you have studied how these kinds of things go when we have disasters, pandemics in the past, what is the length of time that it takes the market generally to recover?
Generally, when it's been one of these viruses that's gotten widespread distribution, it's been 6 months from start to finish. This one's a little more pernicious and will probably extend past that. I think it easily impacts GDP for all of 2020, perhaps some lingering impact on this into 2021. But the caveat to that is 2020 is an election year, and election years are very difficult to handicap because there's just so much money being poured into the economy, both parties trying to curry favor with the voting public. And so I think it really becomes somewhat of a wild card, more so the fact that it's an election year as opposed to it's a year of a pandemic.
Pete, talking about specific areas of the market, we know that the airline industry, for instance, has been hit really hard. Boeing was already in a world of hurt before this whole thing happened. What is your outlook for airlines specifically if they get a bailout?
Well, that's going to be very politically charged. The airlines have had a great run. That's why the Boeing thing was such an issue. They really needed those aircraft. They desperately needed those aircraft for flight line capacity. And when Boeing couldn't deliver them, it put a real hurt on their earnings. Well, now you have the reverse situation where no one's flying, and so you really don't need those aircraft at the moment. And the ones you do have are basically a cash flow drag. Airlines are all about cash flow. It's all about people in seats and those seats moving places. And so it will be difficult for the airlines to plead poor when they've had a 10-year run like they've had, which has been pretty unprecedented for the industry. So this, again, is going to be more politics than economics.
And the oil industry also is really hurting right now. Give us your perspective on that.
Well, this is a whole new dynamic for us. The U.S. became an oil exporter during this past cycle. And as such, it's much more balanced in these cases. Used to be low oil prices were good for the United States, were good for consumers. Well, now we have so much industry dependent upon energy that, in fact, a downturn in energy has a much broader negative impact than the lower price had, just simply the benefit to the domestic consumer. I think this does have the potential to slow up the continued expansion that we saw. And again, this is we're going into a political season, and this is an industry that's not highly favored. The move to a carbon-free environment. So there's going to be a lot of pushback on doing anything at all for the for oil in particular, but for the energy industry as an entire group.
Pete, we've had a huge drop in interest rates, and a lot of people are refining at this point. Tell us what your expectations are for how things are going to go.
Well, one of the things that most investors forget is that interest rates are cyclical. And if you look at the history of interest rates in the U.S. Over 228 years now, you'll notice that interest rate peaks happen with reasonable regularity. The early 1980s was perhaps the most recent example of that. But what you get when you have interest rate troughs, these can go on for decades. So this is one of the real difficulties that retiring investors are going to face, is trying to generate income in what could be a multi-decade period of very low interest rates. And so I think that's been, again, one of the problems that's haunted the equity market, is that you've had bond refugees who've gotten out of bonds and who've gotten into stocks, and therefore in risk environments that they really don't very well understand. So I think that's going to be one of the challenges going forward, is that income creation for the retiree population.
Can you comment on the Fed's plan right now? The Fed is infusing a lot of cash into the markets.
If we needed lower interest rates, we got them all by the market itself. What the Fed's been doing is injecting liquidity, which is very different. One of the problems that we've begun to see emerge in the past couple of weeks, it really started, if you will, a couple of months ago, was that there is a lack of liquidity. As the Fed wound down its balance sheet, tried to normalize, get out of some of the special monetary easings that they had been doing, this drained liquidity out of the bond market. And as a result, it's become increasingly difficult to either buy or sell bonds. Even though rates are very low and you would think it's a very hot time in the marketplace, the problem is no one can carry liquidity, or no one can carry inventory anymore. And so that lack of liquidity haunts investors. They can neither buy nor sell. And so I think this is one of the big threats to the market as we kind of come out of this crisis, is that there's not enough liquidity in the system to keep the markets turning. And that's what the Fed's trying to stay ahead of, because that was one of the characteristics of the last financial crisis that looks somewhat similar to this one, is that lack of liquidity that helps basically lubricate the transactions in the marketplace and enable investors to get in and out of securities.
So what do you think are some lessons from the 2008 crisis that things are going better this time around?
Well, one thing is that the Fed's gotten ahead of it. The Fed is moving very rapidly to get back out in place. They're taking preemptive actions. That's a great sign. They see the problem looming and they're trying to address it. The question is do they have enough, and have they brought it to bear soon enough? Right now, the indications look to be as though they have achieved their goal, and that the markets will continue to function, and that we'll have sufficient liquidity for that to continue. The real proof will be probably in about 6 weeks, when the news, everything fades away, and the world goes back to running perhaps on a little more normal kilter. We'll see if, in fact, that there is enough liquidity out there or not.
Well, and some people are saying that when the market goes back, or when the economy goes back to somewhat normal conditions, that we'll see a snapback. Is that your thought as well?
We could see some periods of initial rebound. I would caution that there are still, there's been a lot of damage done to investor psychology, and that's going to have to be worked through. So I'd be very skeptical of a real sharp, real fast upward move in the market, and that it may be followed very quickly by liquidations and selling for people who basically, are not willing to wait to get back to par. They'll take what they can get and go home and play with their marbles.
The psychology aspect is really significant because it's easy to let fear kind of take over. So what is your advice to people that find themselves in that position where they're just really worried about what's going to happen next?
My advice is write down what it is you think you should do, walk away from it, whether it's for a day, a week, come back to it, look at it again. If it still makes sense, then begin to do half of what you plan to do. If it doesn't make any sense, it was a knee-jerk reaction, it was a panic, throw it away, don't think about it anymore. But again, if you have some deep-seated concerns, write them down on paper, articulate your fears, and then basically step away, come back and see if they're still valid.
So Pete, in a time like this as a chief investment officer, what is your focus when you wake up in the morning and you wonder like, oh gosh, what's going to happen today? What do you do?
Basically, ask the question, what did we miss? Sort of take the null hypothesis. Of all the decisions we've made to put our clients where they are today, did we miss something along the way? Is there something else we should have done? Is there something we should be considering now? And that's the big question, is what is it that's out there that you're not seeing that you should see, and how do you best address that?
And what do you look for to get you thinking in those terms?
Basically, what are the risks? What are the potential returns? Am I taking risks I'm not being paid for? And if so, I should probably stop doing that. Are there opportunities out there that, because of the name of whatever it happens to be, the industry, like oil, to your our earlier point, it may be at such a price that fear has overwhelmed reason, and it's now a great bargain. And it's a study, and it's actually behavioral science. It's called boomophobia. And it's where whatever it was that worked really great the last time, people are terrified of, and the last thing they want to do is go back to that at some point in the future. We saw that in Japan for almost 40 years. So, that's what you kind of look over your shoulder to make sure that you're not neglecting something simply because it blew up at some point in the past.
Well, it's interesting to see the stocks that are doing well. Well, companies like Amazon, Zoom video, kind of like the live and work from home type companies that serve that audience. But others out there that are traditional companies, are there opportunities right now?
Sure. One of the biggest beneficiaries of this is going to be the trucking industry. This country's done a great job of basically getting bad drivers off the road. The bad news is this country's done a really good job of getting bad drivers off the road. The problem we have now is a driver shortage. The average age of an over-the-road trucker in the United States is now into his 60s. So this is not a workforce with a great deal of longevity. Demand is going to be extremely high, and yet we really don't have any way to entice people into that line of work. Automated vehicles and delivery, great concept, sounds wonderful. It's a long way from here till we get to that point in time. So I think that's one of these things you look at. Where could capital be spent? Where are there opportunities? Certainly trucking could be one of them. I think, you could see different forms of delivery becoming far more popular. Much more localized delivery seems to be more popular. Retail as a whole has been morphing over the last really 25 years. I think this serves to simply accelerate that and probably bring those changes to fruition much faster. We're seeing a huge amount of capital being spent on automating retail, as well as automating other consumer services. And I think that's where you see money spent. Not so much on factory floor automation, but in services automation.
Mm-hmm. Well, and certainly following recessions, we come out on the other side with different types of decisions, lifestyle changes, work changes. Any thoughts on the long-term impact of this situation?
It's interesting the number of times I've heard that this is going to cause people to work from home. Telecommuting will become a bigger issue. I think this is now the fifth time I've heard this as a potential beneficiary of some kind of crisis. It happens. but it happens slowly. These are human behavioral issues. They're societal issues. To the extent that it makes something more profitable, makes something easier, it's much more likely to happen sooner rather than later. But for the mainstream and for the bulk of a lot of what goes on within the economy itself, those tend to happen on a little slower basis. But I think it will definitely serve in this particular case to I think institutionalize some of those changes. I do think work from home will become increasingly more prevalent. I think the lockup that we've had in first-time home buying, I think that's going to begin to pass and pass much more quickly now, because I think this is just, again, one of those things that it leans everything in the right direction for greater home ownership. And I mean, the student loan forgiveness, you just go down the line, and there's a number of things that are really promoting individual home ownership, and I think that's always good for the U.S. economy. It's a fairly stable, fairly sustaining form of growth, and it's something that's been missing in this recovery. So if we begin to see it, it bodes well that it's a very stable form of growth for the economy to move into.